Hi everyone, thanks for joining us this afternoon for this webinar about the Singapore market from resilience to recovery. Today we have Nikko Asset Management with us to share about how they believe our home turf ages out as a potential investment choice for your portfolio, and the Nikko AM Shenton Thrift Fund as a possible gateway into the Singapore market. The fund is also viable as a CPF investment option. So with that, we will first start off this webinar with our very own Senior Unit Trust Analyst from FSM1.com, Sean Tiao, to share more about CPF investing and how you can maximize your CPF for your investments. Sean is mainly responsible for the analysis of unit trusts available on the iFAST platform, including FSM1, and serves as a product gatekeeper as well. He's also responsible for iFAST's widely followed recommended funds list. After Sean's introduction to CPF investing, Kenneth Tang, Senior Portfolio Manager at Nikko Asset Management, will delve into the key opportunities Singapore has to offer. Kenneth is responsible for managing Singapore, ASEAN, balanced portfolios and covering the resources sector in Asia. He has 22 years of experience in fund management, both in equity long only and equity long short capacities. So without further ado, let's welcome our first speaker, Sean.
Yeah, so thank you, Sarah, for the very nice introduction. So today I'll be sharing with you why and how you can actually invest your CPF and how you can actually set you up for your golden years. So previously 2 weeks ago, I presented on this topic before. So this will be something that is very similar for those who have actually attended my CPF webinar previously. But I'll try to keep this short and concise and shortened so that we can actually move on to the real meat of this presentation, which is basically the Nikko AM Shenton Thrift Fund. So to begin with, the first thing I think I would like all of you to actually take away from this presentation is that, firstly, markets offer far better returns when you invest for the over long horizons. So I think in investments, we have to accept that there's bound to be wins and losses. But I think from what we have observed over the past 30 years is that markets, they tend to, you tend to win more than you lose. And I think the idea of long-term investment is actually to accumulate more wins and losses. And the only way you can do that is to stay invested. So if you look at the table over here, the red bars basically tells you underperformance, and whereas the gray bar, it means that you have outperformed. So if you look at equities, most of the time it has actually underperformed bonds, for example, just by visually looking that there's more red compared to the bond index excess returns. So across various asset classes, for example, if you invested a lump sum investment since 1989 to 2019, equities would have gotten you about 5.6% per annum in SGD terms, bonds about 5.9% per annum, and your balanced portfolio, which is about 6.2, 6.3% per annum. And if you compare it to actually your CPF OA rate of over the last 30 years, it's only about 2.8% per annum. And actually, these are all in per annum terms. So if you actually compound the difference in per annum returns over the total returns, when you invest your CPF money, is actually way higher than what you can actually achieve with your CPF numbers. So in the further slides later on, I will actually give you like somewhat a practical example as to how this difference can actually translate into dollar terms. So, of course, before we do that, we have to make a few assumptions. So let's just assume that you're a fresh graduate making about $3,000 a month, right? And you already fulfill your 20,000 CPF requirement during your study days, and that you plan to invest all of your CPF monies. Now, that is quite subjective, but again, this is an example. So you plan to invest all of your CPF monies, and that your salary will grow a constant 5% per annum, right? So this is how your earning potential will look like and how your CPF contribution will look like to your CPF account. So what happens when you actually invest them? So these are the results, right? So of course, at this point in time, if you invested in all equities, in the global equities, you would have done the best in terms of how much your CPF will be worth today, followed by your balance, then your bonds. Now, before some of you might ask, like, why is there such a huge difference between equity, balance, and bonds? And if you when you compare it to the first table that I've shown you, equities actually have the least annualized returns compared to the rest. So why has equities from a CPF RSP perspective done the best? And that is because I think this example, this table over here is basically depicting to you how an RSP strategy would look like if you invested in 1989. So the first table is a lump sum investment, and this table takes into account a monthly RSP strategy that you put into your CPF investments. So over time, actually equities have done the best, despite from a lump sum perspective, they have done the worst, followed by balance and bonds. And if you look at in terms of achieving your goals, for example, you have a $1 million CPF retirement goal. Equities will get you there first, followed by balance, then bonds. And this is just like a very good example of that. That if you invest for the long term, if you accumulate more wins than losses, over time, you will succeed. You will more likely to succeed. And because time is the most critical ingredient when it comes to investments. So I think when it comes to CPF investments, the importance of staying invested in the market cannot be overstated. So I think the biggest risks that will come for your CPF investment is actually from yourself. When you actually overtinker your portfolios because your hand itchy, you try to time the market, or that you actually start to take on more risk to reach your retirement goals. Because, for example, you missed out on younger years, you only started saving when you were in your 40s, and therefore you think that you might need to take on bigger risks to reach your retirement goal. Or that if you think that your portfolio returns should match, for example, the S&P index, or you should match any particular index, it doesn't have to be the case. The most important thing is it has to match your goal and your risk profile. So I think when it comes to CPF investments, the biggest advantage that I see for every one of you is that because it's your CPF savings, it's something that you can see but you cannot touch. So this gives you this holding power to actually stay invested throughout the years. And I think you should actually take advantage of this dynamic that CPF has, that you cannot withdraw up to a certain age. So this forces you to sit through volatility and stay invested. And I think another thing about CPF is that monthly contributions from your job and from yourself allows you to make a regular savings plan, regular contributions, and I think the second chart that I've shown you earlier basically highlights that even though, for example, a lump sum investment from 1989 would have done worse, but over time, because of the risk return dynamics of equities, for example, they provide you an opportunity to actually grow this well, even if markets are falling, because you are buying, you're investing at lower prices over a huge period of time. So I think at this point in time, we are all very worried about what's happening in markets right now. With the COVID situation, there are many questions as to will there be like a further downturn? What if I start investing now, and what if this was the top? What if February 28th was the top of markets? So let's go back to history, and I think and I always like to look back at history because it offers very good clues as to what could pan out in the future. So if you invested at the top, let's just use two examples. So for this one, we have the Great Depression as well as the World War II. So if you invested at the top using a lump sum investment, you would have gone through about an 86% drawdown. So that's huge. That is quite a crazy drawdown that I think many of us will not be able to withstand. And in terms of price return, it would take you 25 years just to break even, right? And for World War II, likewise, even though it's slightly better in terms of drawdown, but it is still very damaging psychologically. But if you think about this, if a RSP strategy was a thing back then, right, you would have reduced your maximum drawdown by 67%, and it will only take you 13 months of RSPing throughout the entire period to break even in terms of how much you have put into the portfolio and how much your portfolio value is. Just 13 months to break even. And similar results for World War II, if you actually had an RSP plan, 31% maximum drawdown, and just 7 months to recover from your deepest loss. So this is a very clear example of why time in the market, as well as RSP strategy, could actually benefit you even as markets are falling, or even if sentiment is bearish, because you're not really thinking about the near term, you're thinking about far ahead. And if you believe that, you know, society and the world will continue to progress, then I think there's no reason why you should actually not invest in markets over the long term. So let's just put things more into context, into more recent global events. Okay, maybe not too recent, but notable global events where I think markets have actually seen very large drawdowns. So let's just look at the oil crisis back in the 70s, right? We saw the S&P saw a maximum drawdown about 46%. And an RSP strategy would actually reduce that drawdown to about just 33%. And it would reduce your break even by a large amount, as you can see from the table. I'm not going to go through everything, but it's actually quite self-explanatory. So the key is RSP, as well as a long-term investment horizon, can help to reduce your drawdowns and reduce the time to recover your investment capital. And this will really help with your investment psychology. And the key is to take away from these examples is that when markets go up, when markets go down, you actually acquire more units, and when markets go up, you actually acquire less. So in a way, you get the idea of where we're going, right? So to sum things up, how we think your CPF investing philosophy should be is that most importantly, you have to ensure that you are doing an RSP plan, and as well as that you are also annually rebalancing regardless of whether markets move up or down. Because at the end of the day, you're investing for the long term, and this RSP strategy and this annual rebalancing has proven time and time again that it will help you to generate better portfolio returns over the long term. And secondly, as I've shown in the previous charts and tables, time in the market, meaning staying, the length of time you actually stay in the market, trumps over trying to time the market, trying to time the top, trying to time the bottom, because the truth is not many people can actually do that. And lastly, the third thing that we want you to bring away is that, you know, in investing, you shouldn't chase any short-term trends or fads or make any knee-jerk reactions like what we have seen in markets in recent times, where it can be quite, where markets drawdowns and recovery can be quite fast, and it's generally quite difficult for us retail investors to actually catch the bottom or the top. So with that, I'll hand over to Kenneth, who is an investment director from Nikko AM, who will share with you more about the Nikko AM Shenton Thrift Fund, which is available for investment, for your CPF investments.
Well, thank you, Sean. And allow me the opportunity to thank FSM again and Sean. I will move towards sharing my screen, so just bear with me for a little moment. Okay, great. Thank you everyone again for the opportunity to really share on the Nikko Shenton Thrift, or what we call our flagship active Singapore strategy. It is a rare chance to showcase our equity capability in Nikko Asset Management. So we are indeed thankful again for FSM for this opportunity. Many of you might be familiar with us because you have heard us speak before. Thank you for your support. But for others, this might be your first time. To you, welcome. It's good to see you. I hope that you would find this presentation insightful and useful for you in terms of your investment decisions. The title of my presentation is called Singapore Equities, From Resilience to Recovery. Now, resilience is a familiar word in a time like today, and one defines resilience as the capacity to recover quickly from difficulties and the ability to respond to business disruption, economic disruption, and maintain continuity. Today, I hope to address the topic of resilience and recovery, but from two different perspectives. The first, the market perspective. Is the Singapore market resilient? Is it attractive after the sell-off of 20% during the COVID-19 crisis? And what returns can you expect from the Singapore market today? What are the best ideas? The second is the investment perspective. How can you invest in resilience as a fundamental principle and philosophy? How can you apply resilience in an investment context? What does that even mean? I hope to share with you our team's philosophy in Nikko, our core values and philosophy in investing in these challenging times. I hope to be taking questions as we go along, and we hope that this will be an interactive session for you. So without further ado, let me begin. A quick synopsis of the order of presentation that I will give today. First of all, I will be giving a short intro of who we are, and I will also share with you a bit more about the outlook for the Singapore market. After which I will pause to take some questions that you might have on the broad macro of the market, and then I will continue to proceed with a sharing of the Nikko Shenton Thrift, our active Singapore strategy, and take you through our investment process and our strategy, how we should be positioning in a time like today. So let me begin. A quick intro for Nikko Asset Management. Our corporate profile actually speaks of who we are. We are one of Asia's largest asset manager with a strong passion and focus for Asian investments. And this is really our dedication towards asset management as a business. Now we aim to provide our clients progressive solutions. We are focused on performance, and we stand as a global citizen committed towards ESG with an Asian DNA footprint. ESG stands for environmental, social, and governance scores. Globally, we have more than 200 billion in asset under management. And zooming down to equities, we are actually committed with really an Asian investment team with 19 investment professionals. We have a strong presence in Singapore. And given many of our listeners today might be local Singaporeans, many of you might be familiar with DBS Asset Management. Nikko Asset Management actually acquired DBS Asset Management in 2011 to cement its role and its position in the local fund management scene. A quick synopsis of the portfolio managers, myself and Lai Yu Huan. The Singapore equity strategy is led by two portfolio managers. Together, we have close to about 50 years in terms of experience, which is a strong attribute of our commitment and expertise. In Asia, we are headed by Rob Mann, our head of equities. And together, the senior management or senior investment team really has an experience of about 26 years investing in Asia. Both Yu Huan and myself lead the strategy with a strong support from the regional analysts, together with macro and ESG specialization as well. Now, what is Nikko's investment philosophy? Well, we believe that the market is inefficient, meaning that there are ways that you can take advantage of mispricing in the market through good quality investment research. And we are stock pickers, and in our investment process, we focus on companies which offer two very distinct qualities. Number one, the sustainability of returns, and number two, positive fundamental change. I will illustrate that a bit later on how we actually go about in picking stocks for the portfolio. Now, let's move on quickly to the market outlook and let's review where we are today in Singapore. The first chart is really to showcase what's the worst of the COVID-19 crisis is actually starting to move and progress and move behind us. This is a chart of 4 quadrants. The first two will show really imported cases in Singapore, community infections. I'm sure many of us have actually been paying attention to this on a daily, if not weekly basis. And we can actually see that the worst of the COVID-19 crisis is actually starting to go to move beyond us, right? And we think that is actually a good sign because we are actually coming out into a post-COVID-19 period. Globally, when we look at these trends, you can actually see that cumulative cases all around the world is starting to plateau. In aggregate, we are seeing the world starting to see cases start to stabilize, and many of these cases are turning into recovery. What's also interesting is the rate of infections are beginning to model what many epidemiologists start to actually forecast, meaning some are actually expecting some markets to improve faster, But it does feel that the predictability of this modeling of the crisis is becoming to be more and more expected, meaning we're starting to see peak infections starting to plateau, and that could actually continue to actually filter off in the coming months. And when you see that, you actually start to see cases moderate. We're starting to see mobility restrictions start to be rolled back. In about a week's time, Singapore will actually enter 3 phases of staggered reopening. While it is not the best solution, we believe that it is actually the right solution where Singapore starts to progress into a gradual reopening of the economy. But when you look around the world, we are not alone. Globally, countries are all starting to reopen. China clearly is in the lead here, when you can start to see China being first in and first out, where most of the boxes, including China, Sweden, and South Korea, is starting to show a moderate or yellow trend, which highlights that mobility restrictions are being removed. And there is further good news. When you look at the opportunities in investment, one of the things that we focus on is the government response in handling the crisis. And here is really a measure of the fiscal stimulus that we have witnessed to date. We have witnessed an economic crisis that's clearly very sharp in terms of growth contraction, but the stimulus have also been equally expansionary. Global central banks have come to the rescue with significant expansion on their fiscal budgets, totaling as much as 3 to 5% of GDP. In Singapore, many of us might be actually quite familiar with the Unity, the Resilience, and the Solidarity budget. In fact, today we will have the Fortitude budget. And all this actually amounts to a large part of Singapore's GDP. The support of the economy and jobs from the government is unprecedented and critical in helping the Singapore economy tide over the COVID-19 crisis. And in Singapore, we have also seen the fiscal stimulus being fairly aggressive, probably one of the most aggressive as compared to what we consider to be global GDP. But the reality is we are in a very sharp economic contraction. This is where I'll share a bit more about the less positive news. Global growth is about to experience the largest contraction in our generation. And many of us might remember the global financial crisis or even the 1998 Asian financial crisis, but none can compare to really the severity of what COVID-19 is in terms of economic damage to the economy. And this would mean contraction. In Singapore, we have already seen anecdotal data that shows that the economic contraction is quite sharp. In fact, in the first quarter, 2.2% decline in GDP has been reported, and we believe the second quarter will be much worse. And when you aggregate the full impact of the contraction, Singapore's GDP should be estimated to fall about 4 to 5%. And I think today we also haven't seen a revision of estimates where the government is expecting that growth to be actually in that region of 4 to 7%. Prior to 2020, there were only 2 years in the last 30 with a negative contraction of GDP as large as what we had in today. For example, in 1998, during the Asian financial crisis, we actually had a GDP growth of 2.2%. In 2001, a minus 1.1%. So today, we are actually seeing a much worse crisis. And with economic contraction, we will start to see that flow into earnings. And this is important because earnings or corporate earnings represent the underlying health of the stock market or the equity market. Corporate earnings is expected to fall 11.7% after rising modestly by 1.9% in 2019. And in the subsequent years, there is an expected recovery of 13.4% and 9.2% in the subsequent years. These estimates are not static. They can change and are subject to revision as we start to see further progression of the economic indicators. Another way to look at earnings reversions is to really look at the trend of change, which we consider to be the term called reversions or revisions. And here you can see that that Singapore's growth revisions have been progressively lowered in the past 1 year. But in the last 3 months, that has actually taken a much steeper decline in terms of the downward negative revisions. what we think we need to see is really the stabilization of earnings revisions before we can actually call the bottom of the stock market. And for now, it does still look to be on its way down. The small positive to this is that dividends, which is a function of earnings, is actually showing better resilience and becoming more defensive because it's fallen less in this decline. Now, one of the things that we have done as analysts is to really look back at how this current decline compares to the past few crises that we have experienced. This will be insightful because it gives us a good perspective of where we are today in the economic climate. So you can see in 2020 on the right columns, this is how earnings have performed, followed by how dividend payouts have been, and how GDP growth has performed versus unemployment, and also the outlook for property price indices. And you can see that there's actually a very mixed report card here. For example, on the right chart, on the right column, you can see that while earnings revisions has been very negative, meaning that there's been a lot of revision counts negatively, we have only seen earnings decline by 12%, which is actually not as high as what we experienced in the Asian financial crisis or the global financial crisis. In terms of the dividend payouts, we are actually having a much higher payout today as compared to the previous times of crisis as well. In terms of GDP growth, we are experiencing about an estimated, according to Citi, 8.5%, which is actually more on the aggressive decline as compared to the growth that we experienced in the past. But yet we have seen unemployment rates still remain fairly sanguine, currently expected to be 2 to 3%, as well as property prices, which has only fallen moderately. It is quite intuitive that we think that some of these indicators could be lagging, and we may actually see some of that weakness flow through into some of these indicators. And when we compare, again, with the performance of the stock market, we can actually see that these are some examples that we can also glean as compared to what we're experiencing today versus the time of SARS in 2001, as well as the global financial crisis in 2008. And here you can witness that today's price action is actually a performance of the stock market is actually much worse than what we saw in the period of SARS, but have actually bettered, improved compared to the outcome that we see in the global financial crisis. Now, this is intuitive because during the time of SARS, COVID is actually a less lethal but a more contagious disease. So the impact has been far more severe. But unlike the GFC, we have not really experienced a liquidity debt crisis that we saw in 2008. And global central banks have reacted much quicker during this current crisis. So our takeaway from looking at these charts and looking at history is that, frankly, COVID-19 is quite unique on its own. It's a different playbook compared to the previous crisis. And taking all this information together, it's very important to really look at what are the cues that we need to focus on. Cues meaning the direction before we can actually say the market has truly bottomed. Here we want to look at corporate earnings, the direction of corporate earnings, especially as we move into the reopening phase of the Singapore economy. We need to remind ourselves that indeed today we are living in unprecedented times and also contend with the economic realities of a post-COVID 2019 type of world. Some would call it even a 90% economy, one that is more uncertain, less productive, and that could be actually quite challenging. But when we look at Singapore today, there are clearly some signs and some indicators that I think make Singapore quite unique. So here, I would like to share why Singapore could be quite resilient. Number one, we believe that Singapore macro attributes is actually quite unique. You can see that Singapore is well placed in this current crisis. It has some strengths in the region. We're talking about the order, the security, and our healthcare system that is actually well regarded in how we prepare, enter, and come out of the COVID-19 crisis. There's also a greater lead in terms of sustainability and competitiveness for Singapore. The second point is to really look at our financial reserves. Now, I shared earlier that Singapore has been very expansionary in responding to the crisis. Here we can see the Singapore government is really in a position of strength, where we do not need to borrow and our fiscal expenditure can fully support and buffer the economic declines. And relating to this, I think that's really important, because when you translate the financial reserves into what we call the fiscal trust of the economy, you can actually see that there is a strong impact on corporate earnings. For example, in this chart, DBS actually estimates that because of the 3 supplementary budgets that we have seen, we actually do see earnings being uplifted from a negative 8.9% to one that is far less severe of minus 5%. In fact, this 4% uplift has come because of the resilience budget. The third thing to look at why Singapore could be resilient is really where we are today, when valuations have started to price in a large amount of that downside. We look at valuations from the price to book point of view, and we do see that there's definitely value when the market is trading close to its periods experienced in 1998, 2001, and 2008. And when we look at these indicators, I think the final slide that I would like to share with you, I really enjoyed what Sean showed earlier about taking a long-term perspective. Now, in this chart, you see many numbers, but essentially what this chart shows is actually the MSCI return over a 10-year period annualized at the end of every quarter. So what that means is, for example, if I look at the top left chart of 1.8%, you can actually see that in the last 10 years, ending first quarter of 2020, the Singapore MSCI index will have returned you 1.8% per year for the last 10 years from the entry of 2010 first quarter. So that is actually not exactly a great set of numbers, 1.8%. But when you look back at another time period, for example, in the first quarter of 2013, the number improved sharply to 13%. That means that if you started investing 10 years before 2013 first quarter, at the end of first quarter of 2003, you would have accumulated 13% per annum for the Singapore market for the last 10 years. So this range is actually quite wide, depending on where you start and where you end. But it does show that the returns on a 10-year rolling basis, annualized, can range from as low as minus 0.8% in 2003 in the fourth quarter to as high of 13% in the first quarter of 2013. Now the red bars, what do they mean? The red bars are actually the quarters of GDP growth where economic growth was negative, meaning these are the periods that we are familiar today. For example, in the first quarter where GDP shrank 2.2%, it's a red bar. But when you look back, the 2008 crisis, the 2001 to 2003 period, and the 1998 financial crisis all shows periods where growth has been very negative. But I make a few interesting observations from this. 2, in fact. The first is the highest return of 10-year for 2003 first quarter of 13%, the one in green, actually came from the tail end of the 2001 to 2003 economic recession. Some of you might remember that 2001 to 2003 actually were very difficult periods for the Singapore the market. There was the time where CPF was cut. There was the time where we have corporate restructuring at many levels. But it was also the time that we experienced SARS. But at the tail end, when the economy started to recover, it was actually the bottom of the economy. So if you invested at that point where the economy came out from the recession, you would have actually accumulated a very sharp return. And when you start to look at this from a greater perspective, you can see that timing actually plays quite an important role on what returns could actually have been delivered. Meaning, when you look at the negative quarters of that we experienced in the past 25 years, typically returns on a 10-year forward horizons tend to improve when the starting points are economic recession periods. So depending on really how long this economic contraction actually takes, there is a good chance based on history that when the economic recession hits, that when economies start to come out from these recessions, return starts to improve and can be very attractive on a 10-year rolling basis. So that actually adds a lot of support to what Sean mentioned, that when to time the market is actually quite a dangerous thing. In fact, it's times like these when results and negativity at its worst, where markets can actually give you the best opportunity if you take it on a longer term perspective. The second observation is overall average returns. And here, I think this number will be very similar to what Sean showed, where typically the returns on average for the Singapore market over a 25-year period is actually 5.9%. And that is really based on history and not a forward-looking guidance. So I would say that over the years, the next 5 or 10 years, we may get actually history to be a good guide, but subject to really what the economy starts to perform going forward. And as the Singapore market starts to mature, I believe that even 5.9% could be relatively high in terms of the targets to be reached. So, but this is actually some of the key points here today. So before I start to take a break and go into some of the questions that you might have, I thought we can just give a good summation of really the place of where Singapore is today. The good news is that the prospects of peak of infections are already happening and economies are starting to recover in a fairly staggered fashion, and the market is reacting to such of these prospects. We think the economic recovery will be progressive, but could be very patchy and uneven and take even a long period of time. The good news is Singapore is, after all, resilient and is a good safe haven. The government is well capitalized and have been very generous in buffering the economy. And finally, valuations are cheap. Now, what should we be looking for? We think that earnings is key, and looking at earnings bottoming and positioning for their recovery is going to be very critical in the quarters and the year ahead. Historical returns have actually affirmed this, and overall returns tend to improve as the economy comes out of the crisis. So some of the key highlights here, which I will pause to take a look at some of the Q&A that we might have. So I see we have quite a few questions. Let me run through them very quickly and to see how I can best answer them. Okay, I'll skip on those on stocks, which I will take on later. Okay, can we see the slide again where the lows of the MSCI book values were reached? I will do that right now. Okay, so this is the chart that really depicts how the price to book valuations have changed. And you can actually see one thing that I thought I could, just to comment is that Singapore's price to book has actually been trending lower and lower, and now we are looking actually at a very much lower level. It's important that we look at not just price to book in terms of valuation, but we also look at the returns the market is giving. So there's a very strong correlation of price to book valuation versus the ROE of the market. And Singapore's ROE, return on equity, has been trending lower. We believe that for higher ROE, price to book valuation should actually move higher. So we need to really look at really where returns are improving. So that is a question on price to book. Let me see whether there is more questions on the market. May I know if this annualized 10-year returns is based on lump sum investment at any point? This 10-year returns is based on just average return for the market. So it is really talking about the performance of a market from the time that you invested in over a period of time. I think if you average out returns, it really then comes down to the weighted average of that performance. So I would say that it's better to look at the returns from a 10-year rolling period starting from the inception or the starting of the investment. Do I think the STI will test the March 23rd low? I believe that the STI is struggling with the economic realities of corporate earnings, and we need to really see the direction of corporate earnings that would determine the performance of the market. So I would just say that when we look at corporate earnings as a whole, there is still probably more downside from the current, a 12% decline that the market is forecasting, and we need to be very careful in really direction of corporate earnings. Okay, I see a question on what's the key difference between STI ETF for Nikko and the Shenton Thrift. I'll take it very happily in the second part of my presentation. And can I please show the slide of the Singapore reserves? I will do that as well. There you go. Okay, so I think I participated in a recent forum, and I do really cannot emphasize enough that Singapore is in a fortunate position today, unlike many economies where we do not need to borrow in order to finance the fiscal deficit, the fiscal stimulus that we need to do so. And we think that longer term, this will have repercussions on capital and really what it could mean for long-term investments, meaning the future value, which will eventually come back down to the Sing dollar. Will your Sing dollar, how much, the long-term viability of the Sing dollar? And I think we are in a strong position because of a strong fiscal position. And I think there's actually a very a strong indication that we are still in a position of strength where we can continue to help support the economy in such a time like this. Okay, I would take one final question. Are you implying, in your opinion, the market has already bottomed out? No, I'm not saying that the market has bottomed out. I'm saying that the actual likelihood of the market bottoming out will have to coincide with a recovery of corporate earnings. And for now, the market direction of corporate earnings is still trending lower. And we believe that the market will bottom out. We start to see a revision of earnings starting to inflect positively. This is always the best indication of market bottoms. Okay, with that, I thought I can continue with perhaps another 15 minutes. So thank you for your patience. I'm going to go straight into the portfolio strategy of the fund. Okay. Let me see how to get out of the Q&A. All right. Okay, so why Shenton Thrift? Here, I would really want to emphasize a little bit more about the focus of the Shenton Thrift, Nikko Shenton Thrift. What are our best ideas? Our best ideas for Singapore is really found in the Nikko Shenton Thrift Fund. And here I want to emphasize a few things. Number one is that we take a long-term perspective, and track record is very important to us. The second thing I would just want to say is the importance of cost. Something that I believe is very, very important for every CPF investor. How important is cost, and how compounding of costs can actually matter for a long-term investor. And the third thing you will hear me touch a lot about today in this second section is the importance of active share. Something that we think is very important. Active share is how you express your best ideas and your best convictions. So first, I would just share really about the investment philosophy of Nikko Asset Management in the area of Singapore equities. This is actually a strategy that is actually very, it's a very long, one of longevity. This fund has been around from 1987. So we have actually passed the 30 years of the fund, making us probably one of the oldest Singapore equity funds here today. And our approach is actually active, meaning that we focus on bottom-up stock selection to find companies that again meet our criteria, which is positive fundamental change and sustainability of returns. Again, this investment philosophy is about picking good companies that we believe has sustainable competitive advantage that is superior to the market, that have returns that are better than the market. And here we think that the positive fundamental drivers that are aligned with this is actually what we're trying to do. So the focus on quality and the focus on positive change, we believe can make a difference in a time of stress and economic challenges like today, where investors start to pay more for that resilience. And we want basically a concentrated portfolio. So when we look at today our investment approach, we want to really express our views, but we also want to express our views in a concentrated way. So it's almost as saying that, if I had my 3 and 5 best ideas in Singapore, you will likely see that in our fund, meaning it will be expressed in positioning of that fund, as opposed to perhaps ETF or a more diversified portfolio where you have 50 or 100 stocks, where you have just equally weighted. That's really a diversification approach. We want a concentrated approach that talks about our best ideas and our convictions. And the third thing to talk about is really 3-year. We use a 3-year time horizon, which gives us a very long runway on how we want to see our investment ideas play out in the stocks that we own. We also possess a ESG framework on how we invest. Now, this is a chart that shows a long-term perspective of this fund. It is one of the longest running strategies, as I mentioned, and we want to discuss here just some numbers on performance and returns. The first thing I want to focus on is really our relative returns. Because the fund is an active fund, relative returns is really important. We want to be obviously outperforming the market. And as you can see, in the past 5 to 10 years, there has been times where the fund have delivered excess performance, or what we call alpha, which is the difference between the fund performance and the benchmark, and times where we have underperformed as well. And over the inception, which is for the last 30 years or so, the fund has delivered more than 5% versus about 2% for the STI benchmark. This represents an excess return of 3%. And these excess returns have ranged from a -4 in 2018, where we underperformed the market, to as high of 6 to 7% in the times of 2015 and 16. But overall, our objective is really to focus on consistently delivering on what we call active returns or excess returns. And history has shown that while we have actually struggled at times in short periods, there's been longer times of consistent performance. For example, in 2015 and 16, there were times where the market actually struggled, and we actually did better in a challenge market. And when you look at the longevity of this fund, you will find that performance have actually a higher correlation towards more difficult market conditions. The next table here is really a similar chart that I shared earlier when I talked about the MSCI Singapore Index return. This is the 10-year average returns for the Shenton Thrift. Because we have a long history from 1987, we've actually been able to decompose returns over this period of time. And you can see over the last 25 years, you can actually see the returns of the Shenton Thrift again on a 10-year average return, ranging from 0.9% in the third quarter of 17, which is the return for 10 years, starting from 2007, to a high of 14% in the first quarter of 2013. So this is actually and what we observe is that 10-year returns typically are lower in the recession periods where the economy registers negative growth, very similar to what we showed earlier. And this is also something that we follow. And when you look at the longer term returns, when you compare Singapore MSCI, which is returning about slightly over 5%, Shenton Thrift has averaged 6.7% as compared to that. And the other thing to bear in mind again, which I think is again very instructive in terms of how history has shown, again, not as a forward-looking indicator, but just based on history, is that at times of economic weakness, when we have recessions, the base periods tends to actually be a good leading kind of driver of what returns could be in 10 years' time. Again, this is not a forecast, but really just looking at history. Times of investments, typically in times of stress, usually is a function of a market taking a view that returns can improve as the economy comes out of the return. So for example, in 2001, where returns were very much lower, close to 0 to 3%, you could see how that returns improved over time as the economy started to come out from the crisis. And 10 years on, the returns have actually improved to a number of 10 to 11%. And I think this is the next chart that I will share really about what I mean about being active. Fund managers such as ourselves, which are active, needs to stay true to being active. We should deviate from the benchmark in order to add value for investors. We call this active share. Now, the differentiation of your portfolio versus the benchmark is actually defined as what we call active share, and is really built on our expression of our conviction. So meaning, if I like consumer staples, and if I like information technology as a sector, my portfolio should show it as what the portfolio for Shenton Thrift is showing. We are overweight. And this allows us to be fully in alignment with what we share and what we do in the portfolio. And we express that in the form of our conviction. So today, when you look at the portfolio as of the end of 30th April 2020, the fact sheet does show that we have a current focus on consumer staples and information technology, and we have a positive view on financials and industrials. So when we look at, again, our active weights by companies, we want to be true to being active, meaning we should stop mimicking the benchmark. And looking through our holdings of the portfolio, you will see that there are some companies that are very large in the index where we do not really own. It is really against our philosophy to really benchmark hug, if you use the term, but to focus our attention really on companies that we think is generating strong positive fundamental change and sustainability of returns in this current period. A few more slides before I go into the full Q&A. Is another attribute of Shenton Thrift is the ability to diversify. And here, it's not so much diversification within Singapore, but the fund does have the leeway to invest 30% of the portfolio outside Singapore, depending on the opportunity set. Now here, I would caution that this is predominantly a Singapore-focused strategy, and the investment outside Singapore will really come from the best of breed ideas that we have as an investment team, and our analyst ratings. So sectors, for example, that may have less of representation, for example, in Singapore, healthcare, e-commerce are sectors that are really not well represented in Singapore. This could be an area of where Shenton Thrift could be investing. So this is something that we have the flexibility. And thirdly, cost. I mentioned it's important to really think about cost because we believe for investing, cost solutions, especially for long-term retirement planning and the CPF, it needs to be competitive, it needs to be low. And I think in keeping transparent fees and reasonable fees is actually very important. Here you can see Shenton Thrift as a comparison. Shenton Thrift has a management fee of 75 basis points. It's the same fee in August of 1987, which is why we have a name called Thrift. And it's the same fees that we have today. And when we look at the broader market, we have many active Singapore funds which have a fee structure that's closer to 1 to 1.5%. When we go into the passive space, which is our ETFs, ETFs are charging a range of 0.2 or 20 basis points to 40 basis points for management fees. So we think that Shenton Thrift is well placed, is competitive, and as an active proposition, we think that this 50 basis points discount, if I can use the term, compared to other fees, will add up in the long term for you. When you look back at the long-term returns of Singapore of 5 or 6%, 50 basis points actually amounts to quite a sizable sum. And that is really important in terms of cost, which is really why we need to have cost as a feasible solution for our clients. Finally, when we look at our convictions, I will share a few slides here really about walking through what our strategy is for Singapore. Winston Churchill once said that we should never waste a crisis. I believe that while today may not be the best time from a sentiment point of view to invest, I believe it's important to really look at the perspective of what COVID-19 means for Singapore. It is challenging, but it is also accelerating disruption, is accelerating innovation. In fact, I think COVID-19 accelerates this change and separates what people call in traditional farming, the wheat from the shaft. There's a greater bifurcation of companies that are winning today versus those who are losing. And we believe that we need to be well placed as an investor for innovation, to be avoiding old economy, disrupted industries, and to be investing in companies that are positioned for change. And I shared a little bit about resilience earlier. And we think that really resilience is about the ability to consistently deliver good returns in both good and bad investment environments. So for example, if today is a difficult environment, we're looking for companies that have sustainability, resilience to be able to give you returns on capital that is above the market. And we think that that's really a measure of survivability. And I think this is going to be even more important today. So you want to be invested in these companies, companies that have a strong position in Singapore. Now, this is a chart that we have actually showed in many of our presentations. It's a descriptive view of what we call New Singapore. And this is just a way of how we want to express the companies in Singapore in the way of how it adapts to the new economy. So we want to invest in the growth of New Singapore, meaning the beneficiaries of restructuring and transformation. Now, we believe the service ecosystem, such as healthcare, tourism, logistics, and technology, are attractive sectors with really long-term prospects that we think we can invest in. And we believe that these companies are actually investments that can really ride on the theme of innovation and sustainability. So finding key companies is really what we try to do, and our expression is really in the areas of strength. So for example, in Singapore, we think Singapore is a very strong investment proposition. As I mentioned earlier, we have a very good infrastructure system, but we have also good strengths in transportation. We have good strengths in data management. We have good strength in being a provider of services into the region. So we believe there are good expressions of investments that can actually feature there. Now, this chart obviously is not a recommendation. We have actually been looking also with post-COVID and how COVID have impacted some industries, for example, in hospitality and hotels, which have clearly taken off the future franchise value of some of these stocks. So clearly this is actually something that we reassess as well. So when I look at Singapore, another very key measure to focus on is restructuring. And many of us might look at restructuring in a very negative connotation, but restructuring is actually very much aligned with innovation. You need to restructure in order to align yourself to a new future for the economy. And here we have seen many corporate M&A that has actually been akin to restructuring. For example, the restructuring within the Keppel Group and the many privatizations we have seen in the market is actually a sign of restructuring. And today we do feel that there is continued to be a good color of many companies hoping to deliver better returns through that restructuring. So we are really looking at that opportunity as well. So when I sum up the themes that we want to focus on in Singapore, this is a general discussion of many things that we have talked about, but I will not run into really any specifics. But I would say that, you know, in a post-COVID world today, which some would call a 90% economy, what is really important is resilience. And we want to believe that when resilience starts to impact the whole economy, companies with greater resilience will do better than others. The final slide is a summation again of the proposition for Singapore. So today we are moving into recovery mode. We need to focus on Singapore's strengths, which is its valuations, its government reserves and support, and the transformation of Singapore. But more importantly, as a portfolio manager, we want to remember a few things. Number one, we have to be very focused in what we do, being passionate and a strong investor, focusing on the long term. We want to be really focusing on a cost-effective solution. And most importantly, we need to stay true to being active, meaning expressing our best conviction, expressing it in a proper manner. Today, we think COVID-19 is going to be revealing resilience as important as never before, and there'll be winners to participate in that. So with that, I would pause and take questions, and I'm happy to get Sean to come and moderate the session as we go into a Q&A.
All right, thank you, Kenneth, for a very good presentation on the fund. I'm pretty sure we have learned quite a bit about the fund, but I think there are a lot of questions in the Q&A segment, which I've actually handpicked to actually, hopefully it'll be beneficial for everyone. So I think the key thing that you mentioned earlier is that you will go into the difference between Shenton Thrift and the Nikko STR ETF. So perhaps you want to start on that first?
Okay, sure. I think this is a very good question. I believe that ETFs are good propositions for investment because ETFs are really what we call passive investments. I will not go deeper to explain what ETFs are. Essentially, ETFs it's a replication of the underlying market index. So an ETF is in effect the STI. So when we look at ETFs today, I think that really has a place for investors who really want exposure to the broader market. When you look at the Shenton Thrift, we believe an active solution or active proposition is very different from a passive one. Active is really about conviction, as I say again. It's really about expressing our best ideas in a meaningful manner by taking a portfolio weighting and allocation towards these companies. So for example, what you will get from the Nikko Shenton Thrift and not from the STI ETF is really our process, our investment philosophy in Nikko, which is really about sustainability of growth, of returns, and quality as franchises and positive fundamental change. So our best ideas from our team of analysts was really to find companies that have really good sustainable returns and very good positive fundamental factors driving the underlying investments. So I think that would be a really big attribute. So when you look at the composition of Shenton Thrift, we'd be happy to share more of that with you out of the conference. But the key here is that when you look at ROE, which is a measure of quality, the portfolio today has an ROE score more than the STI. So one of the key differences is because the portfolio companies we own are basically higher in quality based on the financial metrics of ROE. So that's number one. Number two is really the active share. And I think this is important, Sean, because active management is really about conviction and really about expressing that. So one of the things that we want to be careful is really to express the appropriate view towards being active. We should be deviating from the market. So the benchmark, for example, for a large cap company and the weighting in the STI ETF for Singtel, I'm just using example, Singapore Telecom, to be something like 9%. If I were not to like Singtel and I express it because it's a fundamental view, I should be owning 0 Singtel. This is really a proliferation of an active proposition. If I own 8.8% in my Shenton Thrift and I tell you I am negative on Singtel, I'm not doing a good job as an active manager. So this is really where I think the differences are.
Right. I think it's interesting that you brought up Singtel because I think there were other questions about how deep you actually go into picking a stock and why, for example, you have a significant weightage towards StarHub and not Singtel. So
okay.
Maybe you can share more about that.
Right. Okay. So I would like to, because this is our compliance, we cannot provide forward-looking views on companies, but what we can share is really the portfolio holdings that we have as public information. So if I may to just go quickly into the chart that I have, that we have shared publicly, which is our portfolio holdings. And you can see this chart, which is, I guess, talking about really StarHub. I can broadly mention really that, why we have a general view that is constructive. As you remember, some of the key overweight sectors in the Shenton Thrift is consumer staples, it is communications selectively, and also technology. And the reason why we like this sector is really we think that, in the area of, just to address StarHub, is really the area of communications we think is a key essential. And we think that the price competition in the broader sector has started to alleviate, where we start to see greater pricing pressures being alleviated. And there's a lot more stability in the industry structure. That's number one. But why StarHub perhaps more than Singtel? We believe again in its ability to deliver returns a bit better than its peers. And we look at StarHub when we look at the financial metrics of its ROE, its sustainable return on capital. And when you look at StarHub, unlike Singtel, StarHub is actually more concentrated, more focused domestically, whereas Singapore Telecom is really an expression of its domestic business, but also because of its subsidiaries in India, in Australia, in Indonesia. It is more a portfolio, a conglomerate of investment holdings across its investment across the region. So we think StarHub looks interesting because we have a greater expression of the infrastructure and the telecommunication story in Singapore.
Right. And I think previously you shared about how the idea of New Singapore. And looking at this slide, I see that actually there's quite a huge underweight in banks. So how do the banks, the current banks in Singapore, fit within your idea of a New Singapore? Does it have a place?
Right. I think it's a great question. I believe there is there's two ways to answer this. The reality is that today, many of the investment holdings in Singapore are in the sectors of financials, property, and what we call basically, asset-based industries, right? And I think that is really unfortunate that today we have an asset cycle repricing that is being suppressed by the COVID-19 weakness. And this asset cycle needs to play out. So they will come in the form of greater asset quality issues for the banks and probably a reset for also rents or prices for property companies. But there is, the second way I will answer is there is leaders. For example, in digital banking, I believe DBS has been in the forefront of really leading a consumerized platform in really growing that business. It is not a big part in terms of revenues and profits, but they are definitely in the right area of growing that footprint. We like that proposition, and we believe that will place them in a better position against the broader scheme of disruption. So there are relative winners in that sense. And I think if you look at property companies, CapitaLand has also, interestingly, because of recent times, launched an online platform for its malls. And these are really things that we are watching for, where we can believe companies can also adapt towards disruption. But the reality, if I were to look at it more from an objective view, the companies that provide innovation has to be a large part of what we call the Singapore ecosystem of what we call strategic pivots. So we want to be also cognizant that while everybody is also doing their best to fight, disruption and to innovate, there'll be certain companies that have a business model that will be in a better position. So businesses that are asset light, businesses that have a better leverage towards digital businesses. And we believe those companies will do better. So in the case of financials, again, this is a function of our top holdings. Singapore Exchange, for example, is a financial, but really it thrives on market volumes and volatility. And that is actually a part of the market that disruption perhaps is in, if I can use the term, they're on the better side of disruption than the banks, because they're really a platform of intermediation, a platform of distribution of services to the consumer. And we think that that has actually played out in many reasons why companies such as Singapore Exchange, Bursa Malaysia, Hong Kong Exchange, they have actually benefited despite the volatility that we saw in COVID-19. So this is really some of the things that we are looking at.
All right. There's also a lot of questions relating to REITs, because REITs form quite a large part of the Singapore equity market. So how has the pandemic situation actually affected prospects for this sector? Will it cause a drag for equity markets in terms of valuations in the coming years or quarters? Okay. And what's the exposure of REITs that you have in the portfolio relative to the benchmark? Yeah.
Okay. Thank you for the question. I think it's a very good question again. And when you look at REITs as a whole, I think REITs has been probably the best, kind of asset class when we look back at historical performance in the last 10 years within the Singapore universe. And that really is a testament of the success of how Singapore has embraced the ability for real estate investment trust as an asset class. And I think that's really a structural trend. That's really how we look at REITs, and we are very positive on really this asset class as a long-term investment proposition. But from the fundamental, more economic cycle point of where REITs are, I think REITs offer you one thing today, which is really defensiveness. And where we think about defensiveness, again, the key I mentioned many times in my presentation is about resilience. Resilience meaning the ability to keep paying dividends, the ability to, and the willingness to pay dividends is going to be a very critical part of whether REITs continue to perform. And we find within REITs is actually, again, quite mixed. We are, again, stock pickers. So within REIT land, there are some REIT ETFs, but we find greater opportunity today to stock pick and to pick within REITs that are better positioned in today's environment. For example, when you look at what has happened in COVID-19, you do find retail REITs and to a certain extent, commercial REITs are less well placed because it appears that really the business model of really translating rental returns into DPU, which is their underlying earnings, is in some way challenged by REITs. And we may need to see how that model transpires. For example, one of the recent events that we have witnessed is that rental rebates have been given through to retail owners, and that has been actually passed on to the end consumers. So one of the things that we are watching very closely is whether how that business model can continue and whether REITs can continue to pay out. But the reality is that part of the business within REITs is going to be the most challenged. So we are more cautious on retail REITs in general. But on the other hand, you see data center REITs and logistics REITs, industrial REITs actually being less impacted. And some of these REITs actually have been increasing their ability to be paying out and have a position of scale to be able to sustain what we call dividend returns. And here we think that the differentiating factor is not so much about being industrial, logistics, data center, you're good, retail, you're bad. It's really about understanding management, understanding the key companies who are able and willing to pay dividends in a time like this. And we think that there are some companies that are better placed. Unfortunately, I can't talk specifics on stocks, but we do feel that there are certain industries that, number one, are more resilient in terms of the ability to pay DPU. And number two, have a business structure that will allow them a larger return profile of paying out higher dividends. And we're looking for here dividend growth. Growth is indeed a scarce element today. And we think that if REITs are able to give you growth, I think that's going to be really a very powerful proposition. And we think investors should be focusing on that.
Right. Let's just move things back to a bigger picture, right? So which sectors in the Singapore equity market are you most constructive on right now? And if you relate it to the problems that we're seeing in Hong Kong, you know, do you see any more opportunities coming to Singapore that Singapore could benefit of at the expense of Hong Kong, for example? Okay.
I do feel that the unfortunate events in Hong Kong over the weekend are kind of revisiting memories that we saw, you know, about a year ago, and how that translated to obviously capital movement here. I do feel that that trend has always been more in favor of Singapore as a hub for investments, but I believe that the rate of change will probably not change too much. Our view on the latest changes is really more a redefining of some of that, and we don't think that it's going to be intensifying as severely. But just going back to your original questions of how are we best positioned, or how do we think we want to best position the portfolio, we think that there is clearly an opportunity in certain sectors that we think have the prospects of growth and sustainable returns. So when you look at consumer staples today, consumer staples is not really your, in consumer staples in the MSCI definition is really, consumer franchises such as, supermarkets, very essential type of companies, and, food and beverage companies. In the context of Singapore, the consumer staples are slightly different. They are a bit more in agriculture. So I think I just want to clarify that really when we look at consumer staples in Singapore, where we have probably the most sizable overweight, it's not just a function of the resilience that we come to staples as what we need to eat and so forth, but really is the expression of also our view on the individual companies. We have already shown that some of our top active holdings are companies such as Wilmar and Jaffa. So I'll talk very briefly about really the opportunities I see there. I think Wilmar is an expression of the Chinese consumer. I think that's the best way I can really look at Wilmar. I think its consumer franchise has unfortunately been mispriced as a commodity franchise. And I believe this coming, the expected listing of its Chinese business will help to correct investment perception about Wilmar. And one of the things that I think has also been key in our process is really to find sustainable returns for Wilmar. And Wilmar has traditionally not had a very high ROE, but we think that the stability of ROE will start to improve as we go forward this year because their footprint really is in areas of growth in China. For example, in the area of agri products such as flour milling and wheat consumption as a whole. So I think that's really a story. And when we go beyond that, outside Wilmar, the other company that we like is really, in the active position that is shown is Jaffa. And Jaffa is really also a story of protein. And protein here is really talking about food products such as pork, chicken, and really one of the things that we find globally is there's a tightening of supply chains. Today, food is disrupted from a supply chain point of view. I think those who have the volume, those who have the franchise, I think really has a strong position to perform in the current environment. So when we look at it on an overall basis, that's one of the trends that we see in the Singapore context, investors can actually take advantage of. When you go down to consumer discretionary, there is obviously some expressions of what we think, certain consumer chains that are also well positioned. You can't see this in the communication services, but is within communication services we have quite active positioning as well. Likewise for real estate, again, it's also picking the companies that we think are more resilient compared to the overall market.
All right. We're actually running short of time, but we'll just wrap this up with probably the next 1 or 2 questions. Yep. So I think another question that perhaps you might want to answer is that because the annualized 10-year return for the funds has been trending downwards. So is there any reason for that? And what is the team actually doing to address it?
Okay, I think that's a very good question, and it's an observation that if I may, I will just go back. Okay, so when you look, you probably can't really glean too much from the 10-year returns of the Shenton Thrift, but the reality is that the Shenton Thrift's primary investment market is Singapore, and the reason why returns have gradually been declining is the reason for most developed markets as they start to mature. I think the good old days of Singapore's economic growth averaging 3 to 5% is going to be less likely. I think there's going to be a greater contribution of productivity versus growth from obviously underlying supply of labor and really what the economy can expand. But I think Singapore is really evolving as an economic destination of growth. And I think that is going to be meaning that if you invest in Singapore's long-term GDP, that will be also declining, and that's the reason why returns are declining. So I think that's something that we would have to acknowledge, which is why we think that it's important to really find growth. More importantly today, companies can sustain growth, otherwise their returns will come in. I mean, that's really the reality. So when I look at how we manage Shenton Thrift, our focus is really to deliver consistent excess returns above the market, and that is going to be a function of obviously growth overall for the overall Singapore market, which will probably come down longer term. but offset by the ability to get excess returns. So here, I think, what we are committed to do is really to continue to deliver excess returns. But answer your question, will the returns of Singapore and Shenton Thrift decline from an absolute number point of view? The answer would be generally yes, because Singapore is a maturing economic destination.
All right. And finally, I think there is another question with regards to differences between the range of funds that Nikko has. So
Right.
How is the fund different from the Nikko AM Singapore Dividend Equity Fund?
Great
And
question.
should we invest in Shenton Thrift or invest in Singapore Dividend Fund if they have a choice?
If I had a choice, it's my personal opinion, I invest in both. And this is not a tricky question, the way of answering the question, but we have to again understand, why are you buying these funds? I think that's really a question for investors today. When we invest in the Shenton Thrift, it's really an active expression of what we want to invest in growth, in quality for Singapore. When you look at the investment mandate or the objective of the Singapore dividend, it's really about dividend returns, total returns, and how dividends form a sizable part of their returns over the long term. So the investment objective is, while it's really again driven by performance, I think the expression, the design of the portfolio is really about looking at dividends growth and dividend anchors, and that's really a slightly different proposition from Shenton Thrift. So I think that's really how I would describe it. I think it's been it's a great fund. I mean, if you look at the track record of that fund against Shenton Thrift, you will probably find that dividend returns have been very attractive based on history, and I think that's really a fund that you want to tap into for the growth profile for dividends. I think when you look at Shenton Thrift, we do focus on dividends, but we are more focusing clearly on really our general investment philosophy on sustainable growth, our returns, and positive fundamental change. So it's a bit different in design.
All right. I think we have pretty much gone through most of the Q&A questions. So does Sarah, do you want to take over?
Sure, okay. Thank you everyone for attending this webinar. We'll just be very happy to have you listen to our both presentations from the various speakers. And so with that, without further ado, we have ended this webinar, and we will hope to see you in our future webinars coming up soon. Thank you.
Thank you, everyone.
Thank you, everyone.